If you're interested in investing in a multifamily syndication or a multifamily real estate fund, there are some pros and cons you should know about. Sure, there's lots of benefits, but there's also some downside too. And in this video, I'm going to walk you through 5 pros and 5 cons of investing in multifamily syndications and funds. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. So let's get right into it and talk about multifamily pros and cons of syndications and funds. Now let's start with the good stuff. We'll start with the pros and then we'll head over to the cons. So pro number 1 is cash flow. Cash flow is huge. Without cash flow, real estate investments die. And this is one of the big strengths of multifamily real estate. When I first started investing in real estate, I was doing residential properties and the cash flow wasn't there. It was incredibly challenging and that really held me back from scaling because you're always fighting the cash flow crunch. Equity rich, cash flow poor. But with multifamily, because we have the economies of scale working in our favor, multifamily is incredibly strong when it comes to cash flow. And this is why investors love investing in multifamily real estate. And then pro number 2 are the tax benefits. Now we have depreciation, yes, but we also have something called cost segregation, which is basically depreciation put on steroids. And I'll put a link right up here to a video I did explaining all about depreciation and how that works in multifamily real estate. And I think it was Robert Kiyosaki. I'm not sure, don't quote me, but I'm pretty sure it was Robert Kiyosaki who said, it's not what you make, but it's what you keep. And this is why investors love investing in multifamily syndications and funds, because of the tax benefits and the cost segregation. So basically what cost segregation does is we have depreciation. Let's say it's our 39-year depreciation schedule right here. Cost segregation, we are able to front load everything, take advantage of the time value of money. There's also opportunity costs. Why wait 39 years when you can get your depreciation in the first handful of years? All sorts of benefits. So definitely check out that video. I won't go into detail today because this video is just about the pros and the cons. But tax benefits, huge when it comes to multifamily syndications and funds. Pro number 3 is stability. And this is a big strength of multifamily real estate. And I often quote a study on this channel from CBRE where they looked at how all the different real estate assets performed over the past 2 recessions. And now with coronavirus and everything that's happened over the past couple of years, we can really count this as, you could call it a recession. So now we can talk about 3, even though they'll have to update their report. I'm sure there's going to be a new one coming out sometime soon. So when it comes to stability, multifamily real estate far surpassed or far excelled over all the other commercial real estate asset classes. So we've got office space, industrial, and retail. So when we talk about the downside, the downturn, multifamily didn't have a very significant downside. But then when it came to the upside again, the uptick, well, it surpassed its previous peak far quicker than all the other asset types. So not only do you have downside protection, but you have the uptick a whole lot faster, and then you have that accelerated growth. Looking at the past couple of years, multifamily incredibly stable. Incredibly stable. A lot of people will focus on how an asset performs when things are good, but I would argue that it's far more important to look at how an asset performs when things get tough, when we hit choppy waters. And because rule number 1 of investing is don't lose your capital. If you preserve your capital, you can live to fight another day. I would push you to look at how an asset performs when things get tough. And this is where multifamily real estate excels. This is why people love investing their money in multifamily, because it's so incredibly stable when things get choppy. But then we also get the upside, and that's benefit number 4, or pro number 4, is appreciation. Now, in multifamily real estate, we value multifamily real estate differently than we would residential real estate. Residential real estate, we use something called the comparable approach. So basically it's 3 houses on the same street that look the same, sell for 500. Well, guess what? Your house is worth 500. With multifamily, we use the income approach. So it's more driven by the cash flow the property produces. So it's about driving that NOI. And I'll put a link right up here to a video I did explaining all about the value add strategy, because that's basically what we do. We take an underperforming asset or an asset where we can improve it, drive up that NOI, the net operating income, optimize expenses, and that will increase the value of the asset, because multifamily investors, when we get to this large scale, they are buying the cash flow. They are buying a business that just happens to be tied to a piece of real estate. Now, this gives us tremendous opportunity because now we are in control about how our asset is valued. We're not waiting on the 4 houses down the street to go up in value, the market to rise in value, so we can sell for more. No, we have control over what we do with our asset when it comes to driving up that NOI. This is a huge pro because control comes back to us, not just waiting for the market to go up. And the last pro I want to touch on is structuring. With multifamily syndications and funds, we get to take advantage of sophisticated investment structures, the syndication and the fund. And I'll put a link right up here to a video I did explaining the differences between a syndication and a fund. That's just not covered in today's topic, which is more the pros and the cons. So definitely check out that video if you're new to syndications and funds, similar but very different as well at the same time. So when it comes to these sophisticated investment structures, it gives investors, the passive investors bringing their capital to the deal, a lot of protection. Their risk is limited, which is very different than somebody buying a house with, let's say, their brother. They're splitting everything 50-50. Their risk is unlimited at that point if something goes wrong. By using a sophisticated syndication or a fund, if you're investing your capital in the deal, you are really limiting your risk exposure to your initial capital investment. That's it. Now, the sponsor, the general partner, they're shouldering the risk there, and I'll go into that in future videos. But for right now, when we're talking about the pros, we can take advantage of these structures because we're in that larger scale of multifamily real estate, and it really opens up a lot of opportunity. So we talked about all the good things. Well, now let's get into the bad stuff. But before I do, because you're watching this video, you're interested in multifamily real estate, I want to invite you personally to the Multifamily Conference, May 14th and 15th, 2022 in Toronto. We've got Kevin O'Leary, we've got Rod Cleef, Richard Wilson, Joel Block, and Nakeep, Pierre-Paul Turgeon, some really big names, and it's going to be an amazing live in-person event. I can't wait for you guys to come. So I am inviting you right now. Check it out, multifamilyconference.ca. Get your tickets now. So now let's move to the cons. I guess the stuff to watch out for. Now I'm going to cheat a little bit because I'm going to use the last pro we used and also use this as a con. So I'm going to get a little sneaky. So I'll say structuring. And the reason I'm using structuring as a con now is because we're talking about sophisticated investment structures. When we're talking about syndications and funds, we're talking about different classes of shares. We've got general partnership, limited partnership. We've got waterfalls and hurdles. We've got voting shares, non-voting shares. We've got class A, B, and C. We may even have a class A, 1 and 2. It gets a little bit more complex, and that means it's less accessible to everybody. Most people would understand, yeah, I'm buying a house with my brother, we're going to put some elbow grease into it, and then sell it just like we see on HGTV. Even though HGTV sells you lies and it's not a good representation of what house flipping really is, but that's a topic for a whole nother video. I digress. But getting back to this, because of the sophisticated nature of these structures, it's going to exclude people from being able to participate because not everybody's going to understand how this works and how things are structured. And when people don't understand something, they get scared, they get hesitant, and that's just human nature. So it's going to preclude people from investing in syndications and funds just on that basis. So that's why I put that as a con. Con number 2 is minimum investment. Investment. So every syndication, every fund will have a minimum investment amount. So it could be $50,000, it could be $100,000, it could be $300,000. That's going to depend on the sponsor and the deal itself or the fund itself. And again, this is going to exclude or preclude people from investing. Let's say there's a deal opportunity, investment opportunity, it's a syndication, let's say, and minimum investment is $150K. Well, if you don't have $150K, well, you're not investing. That's going to exclude you from that investment opportunity. Now, there's 2 ways to think about this. I think about this more as a positive because if I'm investing as a limited partner, a passive investor, I don't want like 500 different investors in this deal. I would rather have a much smaller group, but have people with more skin in the game. That's going to make the deal ride a whole lot smoother. There's probably going to be less issues down the road, and everybody's going to be a lot more dedicated to making that investment work and not causing issues. And plus, from the sponsor point of view, if you have 30 investors versus 100, well, you can give a whole lot better customer service and have much better communication with your investor base. So everybody wins in that respect. So yeah, it's a pro. That's how I think about it. But I think the theme with the cons you will see is that it's all about excluding people and the sophisticated nature of the structuring, and then the minimum investments required. It's basically excluding a large portion of the population. And that's a good segue into number 3, which is investor criteria. So with investor criteria, the government sets criteria that an investor must hit to be able to participate in these sophisticated investments, either based on income or assets. And I'll put a link right up here to a video I did explaining all about the accredited investor criteria. Basically, what it does is it says, hey, you have to hit this income threshold, or you have to own this much of net assets for you to be able to qualify to invest in these opportunities. Now, there's a difference between 506B and 506C. I'll go into that in that video, not in this one. But basically, generally speaking, you must be an accredited investor, with a couple exceptions to that when we're talking about 506B. But we won't go down that rabbit hole. But like I said before, it's all about excluding people, and a large portion of the population does not fit this criteria. So they can't even participate in these investments. And that's why I put that as a con. A lot of people can save up the down payment and some rental money to go do a deal with their brother or a friend of theirs. That's a lot more accessible than these more sophisticated investments like syndications and funds, which to me, it's a good thing, but for the purpose of this video, I'm using that as a con. Con number 4, illiquid. Your money goes in, it does not easily come out. And I look at this as a con as well. Some people may argue with me, but when we look at the stock market, people get fearful, and that's why we have the big swings in the stock market, because the stock market is very liquid. You can buy a stock one day, sell it the next day. You may be selling at a loss, but you can get your money out pretty quick. Real estate does not work that way. And especially with syndications and funds, your money could be tied up for 3, 5, 7, 10, 15 years, depending on the opportunity. So basically what I tell people is, when you're investing in these investments, these investment opportunities, think of your money being locked up in a vault, and you can't get to it. Now, there are ways to get it out, and that's going to be laid out in the PPM and the OM. You may be forced to sell your shares at a discount. Other people, you may be limited on who you can sell your shares to. That's a topic for a whole nother video. But for the cons, it's not like you can get your money out if there's an emergency really quickly. So always keep this in mind. Like, it's not like you can invest in next year. Oh yeah, I just need my money out. Give me back my $200,000. It doesn't work that way. So you'll always want to plan for worst case scenario and understand the process that you have to go through in case you do need to access that money. What are your options? What can you do? What limitations do you have based on that specific offering that you invested in? So it's definitely a con, but also it's a pro, because it keeps you from making a knee-jerk, rash decisions based on fear, which is what a lot of people end up doing. And last but not least, the last con is you need a team. You need a success team. And a success team is, at the bare minimum, is going to have a lawyer, an accountant, and then later on you're going to have insurance, you're going to have a wealth planner, and then succession planning goes into that, and then the list starts growing. But bare minimum to start off, you need a lawyer who is experienced in sophisticated real estate investments, and an accountant experienced in sophisticated real estate investments. And so again, this is excluding people, because if you're just buying a house with your friend or something, the lawyer closing the deal for you doesn't need to know about the fund setup or a syndication structure and how waterfalls work and how preferred returns work and all of that stuff. You need a specialist in this case. With the lawyer, they need to read through the PPM or the OM, the offering memorandum or private placement memorandum, and look for all the red flags. Make sure your interests are looked after. They're going to look at what happens in worst case scenarios. Everything laid out in that investment opportunity is laid out in that PPM or OM, and that's the lawyer's job. Now with your accountant, we talked about the tax benefits and depreciation and cost segregation. Well, does that accountant know how to use all the bonus credits you get with cost segregation, or do they know how to effectively use depreciation to minimize your tax liability? This is where you need somebody who's very knowledgeable in sophisticated investment structures so they can best serve you and make the investment work for you the best it possibly can. Not every accountant will be able to do that. Not every lawyer will be able to do that. So you have to get the right people on your team. And then we get into insurance, wealth planning, succession planning, and that comes further on down the road. But this is a con because you need the resources, you need to build that team so you can have success. It's not like you can just go through the yellow pages. Well, yellow pages don't exist anymore. It's not like you can just Google accountant near me and just hire the first person you talk to. You actually go through an interview process to make sure it's the right fit. So those are the pros. Those are the cons. Some of the cons ended up being pros, in my mind at least. Maybe I should have come up with a wishy-washy column right down the middle, but that's the way it looks today. So we've got the pros and the cons of syndications and real estate funds. If you like this video, if you found this useful, hit the like button, let me know what you think, leave a comment. It really helps out the channel. And until next time, happy investing.